Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the grains, Mark Soderberg. With the Trump administration talking up progress on trade negotiations with China, how will this impact soybean prices?
Well, initial reaction here has been quite supportive, with prices surging to a 4-month high here in early action this week. Over the weekend, U.S. Treasury Secretary Bessent was making the rounds on several media outlets, stating that the framework for a trade deal with China is in place for later this week when President Trump meets with a Chinese leader Yi on Thursday in South Korea. While specifics are lacking, Bessent did suggest that under the terms of the deal, China would be a substantial buyer of U.S. soybeans for many years to come, while the threat for the return of much higher tariffs, along with restrictions on rare earth materials, would be paused. While there's no indications yet in the cash market that China is inquiring about U.S. soybeans, the market remains hopeful that U.S. will help fill some of the estimated 300 to 325 million bushels that China needs for the December-January timeframe. So, in my opinion, for prices to push much above their summer highs, which we're rapidly approaching, I think we need to see more concrete evidence of Chinese demand. Also, the U.S. with the government shutdown, however, now nearly 4 weeks in, we're really kind of flying blind here as announced sales are lacking. The current USDA export forecast of 1.685 billion bushels, that's clearly too high without Chinese buying. However, I do think we can still reach 1.6 billion bushels if China starts buying some U.S. beans here rather soon. This window, however, is not terribly long, as by February of next year, China's demand likely shift back to Brazil with the arrival of their new crop harvest. Also impacting prices, the other side of the equation, which is supply. Here, too, we are flying a little bit blind with the partial federal government shutdown. Obviously, we did not get a October production report, and November report is now in jeopardy if that shutdown lasts into its 5th week.
Well, keeping with the soybean markets, what is your production estimate for the U.S. 2025 soybean crop?
Like most, I'm leaning a little bit lower here as late season drought stress did negatively impact this year's harvest. My production forecast is 4,240 million bushels. That's down 61 million from the USDA forecast in September. My average yield works out to 52.8 bushels an acre. Well, it's still a record high. It is below the USDA estimate at 53.5. Historically, if you look back years like this, where the USDA raised their yield forecast in August only to lower it again in September, that's only happened twice now in the last 35 years. And both years, final yields were below that September forecast by an average of nearly 1 bushel an acre. So, in my opinion, it's not too terribly hard to make an argument for soybean prices back above that $11 bushel if U.S. demand can hold up with the return of Chinese demand coupled with U.S. production going lower. I think ending stocks could start to drive below 300 million bushels. So gradually, however, the market's attention will start to shift to South America and their production prospects, which right now are off to a pretty favorable start.
All right, thanks, Mark. Now over to JP on financials. JP, what economic events will shape markets this week?
There's a lot going on that will drive market direction this week. We've got a host of central bank meetings, a highly anticipated meeting between President Trump and President Xi, as well as a slate of corporate earnings. Starting off on the monetary policy front, we have policy decisions coming out of the Federal Reserve, the European Central Bank, and the Bank of Japan. The Fed is widely expected to cut rates at this meeting despite the absence of government data over the last couple of weeks. Labor market weakness has been the main concern for officials in the Fed, and despite not getting September's non-farm payrolls report, officials expect that the labor market continued to show signs of strain and subdued hiring. Private figures as well have also pointed to weakness. ADP's private payroll report showed a net loss of jobs in September, and revised figures showed a net loss of jobs in 3 out of the last 4 months' reports. Although it is widely expected that the Fed will cut rates, markets will still closely analyze any sort of commentary for signals on how far and fast rates could fall, with markets expecting the Fed to cut rates again in September per Fed funds futures traded on the CME. The European Central Bank's policy meeting on Thursday will also be in focus, although no change in interest rates is expected. The deposit rate, which is the ECB's benchmark rate, is set to stay at 2%. Recent commentary out of several officials there have signaled that the current interest rate level is well positioned and well positioned to also respond to any developments in the economy there. Inflation and unemployment have been little changed over the last couple of months, giving wait and see policy a strong go ahead for the time being. In Japan, markets are widely expecting the Bank of Japan to hold rates steady. Speculation is growing as to when the Bank of Japan will resume its rate hike cycle again. The recent election of Japan's new prime minister has added a layer of uncertainty to that, as she is expected to roll out an expansive fiscal policy in the next couple of days or weeks. The Bank of Japan will likely want to have more time to assess the impact of U.S. tariffs on the economy there, as well as communicate with the new administration there as well. The BOJ will also release growth and price projections during their meeting as well. After that, we have the meeting on, well, excuse me, I should say on Thursday, we also have the meeting with Trump and President Xi. U.S. and Chinese officials have signaled that weekend talks had paved the way for a strong breakthrough in the trade standoff. Secretary Bessent told reporters on Sunday that they have a very successful framework for the leaders to discuss, helping ease some trade worries there. President Trump also said he believes that they will come away with a good deal. Now, lastly, moving to the corporate calendar, we have the Magnificent Seven stocks set to provide a big catalyst to the markets this week, with the arrival of quarterly earnings from Microsoft, Alphabet, Meta. Those are due Wednesday, while Amazon and Apple are scheduled for Thursday.
All right, JP, briefly, what should traders focus on for the Fed's upcoming meeting?
Yes. Now, although markets are expecting the Fed to move to cut rates on Wednesday, yes, I should say Wednesday, and again in December, especially given last week's tame inflation reading, which saw prices rose below expectations. Headline CPI rose to 3% on the year. That was below an expected reading of 3.1%. Now, despite inflation remaining elevated, the Fed is expected to move to be more accommodative to the labor market, which, to no surprise to anyone, has shown weakness. Now, given that inflation still is an issue for the Fed, markets will closely analyze any comments out from Powell for any clues as to how far or fast rates will move in the future. Right now, Fed funds futures are showing a 96% chance of a cut in December. And now, also, aside from monetary policy, a big point of focus for markets will be announcements on the Fed's quantitative tightening. That's the practice of the Fed reducing its balance sheet, as Fed Chair Powell recently signaled that the end of QT is approaching. This could be bullish, I should say should be bullish for treasuries, because it reduces their supply in the market, pushing prices higher and yields lower. An exit from quantitative tightening also means that the Treasury's financing requirements would decline, because it no longer needs to borrow as much to cover the Fed's redemptions. Under QT, the Treasury's borrowings effectively increase as the Fed shrinks its balance sheet by letting the bonds it holds mature. The Treasury redeems the debt and pays the U.S. Central Bank. So now an end to this would mean that bond supply would lower, which would act as a nice tailwind for bond prices and send yields lowers. So in short, both monetary policy and balance sheet strategy are in focus, with the implications for rates, yields, and broader market sentiment in play on Wednesday.
All right, thanks, JP. Moving over to the energies, Mark Bowman, is there a bullish case for natural gas?
Well, one thing that's happened is it's finally turned seasonably cool up here in the northeastern quadrant of the lower 48 states. We saw some cooler temperatures emerge last week. Forecasts call for below normal really to stick around for at least the next couple weeks. Now, this isn't screaming a cold wave or anything, but at least allows for a more normal pattern to develop after a warmer than normal trend in the first part of the autumn kept heating demand low. We are in a build season for U.S. storage, and build rates, though, have been below the 5-year average for the past 5 weeks, which is also kind of a change. Our storage is still running about 0.6% above a year ago and 4.2% above the 5-year average. But that may start to slip if the weather stays seasonal. Other factors that are supportive is that could slow the build is a lower domestic production, which has fallen off for its peaks from August. August, we were doing about 108 billion cubic feet per day. And so far this month, we're down to 106.7. We've also seen export demand reemerge. The LNG amount of gas flowing to the 8 big LNG export plants, according to LSEG, is now around 16.5 billion cubic feet per day. That's where we're running this month, which, if that holds, would mark a new high. The previous record was 16 in April.
And last question, Mark. How about a bullish case for cotton?
Well, it may not be as clear as or as optimistic maybe as the natural gas situation, but we have really pressed low in this market off the relatively strong U.S. crop and really poor export sales outlook. We really have only to go on these conditions as far as hard data is the last conditions report before the shutdown, and at that point, U.S. crop was 47% good to excellent versus a 5-year average of 40%. And more importantly, Texas was 41% versus a 5-year average of 26%. They have the biggest crop, the most area, and that their conditions can change dramatically from one year to the next, thereby creating a big crop or not so big crop for the U.S. in general. Weather conditions pretty much supportive for crop development in Texas. It's been tending dry, which is good for late season development and harvesting. There have been some problems developing first in the Delta this summer and then the Southeast, both of them in a drought situation now. As of last Tuesday, 62% of the crop was in an area experiencing drought. Again, now this may be late to really make that much difference in Georgia. They were running behind, though, in late September, 43% good to excellent versus 55% on average. Delta in especially Mississippi, only 32% versus a 5-year average of 59%. But none of this is a surprise, except that we may be a little lower overall if Southeast got worse. The other issue, of course, is demand, and we did get some support over the weekend with the possible trade deals with Vietnam and probably more importantly with China at this point. Vietnam has been the largest buyer this year, as they have been the last few years. And as of the last sales report, they're actually running ahead of last year at 975,000 bales. And that's the largest point for this point in the season in 2020 since 2021. So they're off to a strong pace, probably wanting to, in response to the threats of tariffs and wanting to show that they're willing to buy U.S. cotton. In contrast, China, only 69,000 bales so far this year. That's the lowest in at least 11 years. It compares even 400,000 around that time last year. So, and last year was poor. So this does leave a lot of room for some buying. We suspect most of the focus will be on soybeans, but it does create some optimism that something may happen in the export sales. And given how low we've gotten in cotton prices, it could leave the market in a position to finally start to build a base and rally off on what could be a better outlook.
All right. Thank you all. Remember, the views and opinions expressed here today are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.